To nobody's surprise, the Fed has kept their rates near zero at today's FOMC meeting. But what does the future hold in terms of monetary policy? Well, we're here to talk about that with Danielle DiMartino Booth. She is an expert on Fed policies, and she is the CEO of Quill Intelligence. Danielle, welcome back to the show.
It's great to be with you again. Happy Fed Day.
Happy Fed Day. We were talking offline. That should be a holiday, but it can't be for us because we have to talk about it and give news to the audience. Now, today we have had some statements from the Fed that I like to ask you about because they are quite nuanced, as you told me offline.
At this meeting and in coming meetings, we're going to be continuing to assess the economy's progress toward our goals and give advance notice. We'll be trying to provide additional clarity about our thinking, both in the post-meeting statement and in the minutes and in the public comments that people make. Our approach here has been to be as transparent as we can. We have not reached substantial further progress yet, so we're not there, and we see ourselves as having some ground to cover to get there.
What are they referring to exactly? I thought the economy was improving quite well. Apparently, it isn't, according to the Fed. What do you think?
Well, today was a study in dichotomies because Chair Powell, especially in the press conference that followed, he was extremely adamant about the fact that growth is great and that the Fed's not ready to do anything about it. So there was a lot of, on the one hand and on the other hand, going on. He mentioned the strong payroll growth in the month of June and that print, and the fact that the United States economy has recovered from the virus more quickly than other nations around the world. And at the same time, he said that though discussions have begun, they're still not at the point where they can even begin to signal that they're going to be tapering purchases. He was even asked what he would be speaking about in late August at the Jackson Hole meeting, and he deferred. He said, well, I have no idea at this point. So it was painfully nuanced, and the intent was obviously to convey nothing.
I thought that the expectation was that they would start tapering their purchases of mortgage-backed securities. Is that not happening?
It does not appear to be happening. One of the last questions that he was asked during the press conference pertained just to that subject. And he did concede that there's definitely a vigorous debate going on inside the Federal Open Market Committee. There are at least 3 or 4 different Federal Reserve district presidents, but also the newest member of the Federal Reserve's Board of Governors, who's come out and said that the mortgage-backed securities quantitative easing could be detrimental to the white-hot housing market. So, it was interesting that the question was raised, but he's sticking with the philosophy held by New York Fed President John Williams, who is, of course, a permanent voter on the FOMC and vice chair of the FOMC. And his opinion is that low mortgage rates inevitably trickle down and benefit all households. I think we've seen empirically that that's not the case, but that's where Jay Powell is sticking his opinion. He's in the Williams camp.
Well, if they stop purchases or even slow down the rate of purchases, isn't it possible that we'll see a slowdown of the housing market? And is it possible then that from there we could see a slowdown in consumer growth and consumer spending as people think, oh, gee, my houses aren't growing as fast as anymore. I'm not as rich as I thought. And so that'll have a trickle down effect, as you said, on everything else in the economy. What do you think?
Well, and that's a risk. And that's the problem with Fed policy, is that there are no right answers at this point. They have gone down this rabbit hole so far. We know that we exited recession in April of 2020. So we know that extraordinary and emergency policy has been in place for 15 months now and counting. So they are in between the proverbial rock and hard place, in that if they do signal tightening of any kind, then it could indeed have a trickle-down effect and dent consumption. The flip side of that is, and I'm starting to sound like an economist myself, but the flip side of that is that we've seen the fastest home price appreciation in luxury homes, in the highest level homes. We've seen the majority of the wealth, whether you're talking about residential real estate or the stock market, accumulate to a very small cohort of Americans, whereas if we did see housing prices start to come off their highs, might that in the longer term benefit individuals who cannot afford to either rent or buy right now?
Well, let's put everything together now, Danielle. Let's analyze the economy as if you were still part of the Fed. If you were on the FOMC right now, the factors you would be looking at. Well, we know that inflation has trickled up over the last couple of months. We've had at least 3 months where it's above their 2% inflation target now. We know that unemployment has continued to fall. Wages, however, if you look at the Atlanta Fed wage tracker, that shows that wages have actually not risen. In fact, they've been stalling, if not falling, which is a curious thing in itself. We know that there's a labor shortage in some sectors, and we know that consumer sentiment, according to some sentiment indices, are still high. However, the GDP is expected to be, 9% growth this following quarter. How would you read this? How would you read these prints? How would you consider growth right now relative to maybe prior expectations from last year?
Well, I sure do wish that I could put it all together for you, as you've asked, but there are a lot of conflicting messages in the data right now. We have to remember that there's still 12.5 Americans collecting some form of unemployment benefits. And that, that pits itself against the 9 million job openings that are out there. But it's very hard to say what the true state of the U.S. labor market is right now because we don't have a fully replenished labor pool. We have many Americans who, for one reason or another, whether they're collecting additional unemployment benefits, whether they're making more than they would if they were back in the workforce, whether they're mothers who are waiting for schools to reopen in the fall and hoping like heck that the CDC does not attempt virtual learning again so that they can pour back into the workforce. It's very difficult to determine right now where the labor market is. And that's where the Fed's dual mandate. In other words, they have to minimize inflation, but at the same time, maximize employment. That's where it gets really tricky for them because they're two opposing forces. And Jay Powell today in his press conference indicated he's going to lean into the Fed's mandate for employment in terms of when he feels like the Fed can begin to tighten. And we know that we're nowhere near the 3.5% unemployment rate where we were prior to the pandemic hitting.
Let me ask you just very simply then, what are they waiting for in terms of tapering or even tightening? What are they waiting for? Are they waiting for inflation to get even higher? Are they waiting for signs, definitive proof that inflation will be not transitory? Or are they waiting for, like you said, the labor market to become even more tight, for unemployment to come down even more?
I think they're waiting for both. And the Chair Powell's, the number of times he used the word persistent and persistently today, it reflected the fact that they're waiting to see if inflation is going to become entrenched, which is very risky behavior because entrenched inflation is something that's difficult for the Fed to combat. And at the same time, they are waiting to see the unemployment rate come down, and not just the unemployment rate for the broad U.S. economy, but the diverse unemployment rate, the African-American unemployment rate, the unemployment rate for Hispanics, the unemployment rate for women. They're waiting for all of these to come down in order to satisfy their new inclusionary policies. So it gets very tricky. But to your point, if they wait, if they wake up one day and see the whites of the eyes of inflation, it might be too late.
Okay, so let's talk about first your outlook for the economy, and then we'll talk about your outlook for monetary policy. First, on the economy, I know you and I have spoken a couple of times. I remember the first time I asked you this, I think it was late last year, you had said it's possible, not likely, but it's possible we'll see another recession soon. Are you still sticking to that view, or have things improved for you?
We have started to see some late cycle indicators. Of course, we're seeing pushback on the part of households because home prices have become so high. Cox Automotive came out with a forecast that July is going to be the third consecutive month of year-on-year declines in car prices. Housing and autos are your two most interest rate sensitive sectors of the economy. With interest rates as low as where they are, for those two sectors to be behaving as if it's late cycle. And we're seeing other indicators in terms of jobs, job availability inside of some of the confidence data also that are signaling that we're late cycle. And I'll try and put a little bit of perspective on this as quickly as I can. Prior to March and April of 2020, the shortest U.S. recession technically on record, the prior one was in through June of 1980. And that was a 6-month long recession. I will tell you that the recovery that followed was only 15 months in length, and then the United States fell back into what was called a double-dip recession at the time. And my concern is that so much fiscal stimulus monies have been poured onto U.S. households. If there's not an encore of fiscal stimulus, and if we're already starting to see signs that the economy is slowing, And we're not even bringing the Delta variant into the discussion, that we could have already potentially seen peak growth in the U.S. economy.
Yeah, the Delta variant is a concern. I've spoken to some medical professionals. Even they think that not all vaccines would be, well, depends on the person, but it's possible vaccines would not be even effective in some cases against the Delta variant. But that aside, do you think the Federal Reserve shares your view on their outlook in the economy? Is that why they're waiting? Do you think they're afraid of such a double dip recession?
I think more than anything else, if you look at how tightly the employment, the labor force moves with the stock market, if you look at how tightly the labor force moves with housing prices, unfortunately, I've just run both of these correlation analyses, and you actually see that it is incumbent upon the Fed to make sure that there's no tightening of financial conditions, which is an elegant way of saying the stock market doesn't decline. And that, unfortunately, is how I perceive the Fed's priorities right now as making sure the stock market doesn't come down, tighten financial conditions, and that bleed into the real economy. Is that the right way to make monetary policy? Absolutely not. But I think that is the tail that's wagging the dog right now. And for good reason why the Federal Reserve policymakers have come under fire. Because again, we're not talking about inflation that is slightly above their 2% target. We're talking about levels that are running at twice that right now. So the signs are flashing that policy is too easy right now.
So what do you think the tapering timeline is right now? I'm not asking you what it should be, because I know if you were the head at the FOMC, maybe you would be doing some things differently. But what do you think they are planning right now in terms of a tapering timeline?
So the fact that Jay Powell would not even give a hint as to what he was going to talk about at the Jackson Hole meeting at the end of August suggests to me that they might be talking about announcing a taper as late as the September or December meeting. Well, we'll have to see, meaning that they won't actually begin the process of tapering until 2022. And that sets up the scenario that we've seen in the dot plots where FOMC members indicate where they think interest rates will be in years out. Most of them don't see that first rate hike coming until 2023. If you don't start the taper until 2022, that kind of lines up the Jay Powell timeline.
Well, Powell likely won't outright say exactly when or how. He might drop some hints along the lines. What are some of these hints you might be looking out for in terms of keywords or attitudes?
Well, in these next few days, because blackout ends as of midnight tonight, in these next few days, I'll be curious to see what other members of the Federal Open Market Committee are saying, because there was obviously a lot of dissent and debate surrounding mortgage-backed securities purchases. So it'll be interesting. No chair can handle mutiny. And Jay Powell may want to take as measured a pace as he likes, but I'll be interested to see, and I rarely say this, what other members of Fed leadership have to say in the coming days and weeks leading into Jackson Hole.
Why is that you rarely say this, Danielle? I'm curious.
Well, because typically a Fed chair speaks for himself, is an Alan Greenspan, a Ben Bernanke type. But in the press conference today, Jay Powell said, it's not up to me to say when inflation has been persistently too high. That is a signal that the committee is going to have to make as a group, which was kind of surprising to see because most Fed chairs speak from a position of power.
Maybe he's waiting for Janet Yellen to drop hints like she did earlier in the year. I kid, of course, but maybe he is.
Good one.
That would be hilarious and possibly true. Okay, so your outlook for the markets then, putting this together, what would happen to the stock markets if we have tightening? And tightening can mean a number of things. It could be a reduction of mortgage-backed security purchases. It could be outright raising of the interest rates. How do you see things playing out?
Well, I think that we've got that playbook to look to, right? I mean, we've got the episode of 2017 going into 2018, which was not pretty, and that was the last time that the Fed was trying to reduce the size of its balance sheet and increase the Fed funds rate and make an attempt at normalization that failed. So the stock market didn't like it one bit, and that was what triggered the Powell pivot. And we haven't seen him pivot back since then. And I get the sense that he has no intention of doing so until the data truly force his hand.
Okay. And I've heard some economists argue that at a certain point, interest rates would rise to a point where they would completely decimate our economy. We wouldn't be able to afford interest rates at Actually, this was brought up to Jerome Powell at his last testimony just a month ago or 2 months ago. One senator asked him whether or not he sees the economy being sustainable should interest rates rise back to the historically high level of 5.7%. And his answer actually was straight up no. He doesn't see this as being sustainable. Is there a rate for you at which is kind of the absolute ceiling for the federal government? Past that rate, they wouldn't be able to afford interest expenses?
I think that number is lower than we would think that it would be. I think that number is probably somewhere closer to the 3 to 4% range, which is just, it's astonishing, historically speaking, to put that into context. But that is what the market told us when Jay Powell was endeavoring to get the Fed funds rate to 3% and couldn't do so. So they call it the natural rate. And I think that the natural rate that can be withstood by the U.S. government, given it's pushing $30 trillion in debt, is a much lower threshold than anything you would think to be a historical norm, such as 5.7%, which is inconceivable.
Okay, so given your outlook, given the expectations that you've outlined for monetary policy, finally, how should we be positioned right now as investors?
Well, I think that when you see situations like last Monday when the Dow Jones kind of hiccuped down by 1,000 points and you went, whoa, what was that? Those are little shots to suggest to you that you should definitely be at least at a minimum hedged with your positions, defensive, be sitting on some cash at this point, and certainly don't let go of your gold.
Thank you, Danielle, for coming on the show today. Excellent to have your thoughts as always. Thank you.
Thank you for having me.
And thank you for watching Kitco News. I'm David Lin. Don't forget to subscribe to our YouTube channel and follow me on Twitter at DavidLin_TV.